So the market is brushing up against all-time highs, with the S&P 500 just crossing 6,500 points for the first time. So naturally, investors are asking the question, does it still make sense to invest in the broad market index, or is it time to look elsewhere? And it's a fair question. The S&P 500 has never been that high, and it also has never been that concentrated, dominated by the Magnificent Seven, most of which are priced for perfection. But the truth is, opportunities still exist, just not where most people are looking. To find them, you need to go beyond the current AI and tech hype and dig into industries that have been overlooked. This is why in this video, I will cover 5 companies that may just fit this bill. Here is how I picked them. First of all, I look for companies that are well below their all-time highs. This means 30 to 15% below their peak, which may offer potential entry points. Second, I look for fundamentally strong companies, which means basically solid market demand for their product or services, and also consistent revenue and earnings growth. And third, I looked for a potential of overreaction, which basically means stocks where the current negative investor sentiment might just be a little bit overdone. And I will go through each of these stocks in this video and present the data in an easy and digestible way, so you have all the information that you need to make a potential contrarian move. But before we get to it, let me just give you the standard disclaimer. This is not financial advice. So let's get started. First up on the list is Novo Nordisk. This Danish pharma company is behind 2 of the most famous weight loss drugs, Ozempic and Wegovy. These drugs are used to not only treat obesity, but also type 2 diabetes, which makes it a really large and also growing addressable market. And the trend towards obesity is definitely there. More than 40% of adults in the US are classified as obese, and this trend is not expected to reverse anytime soon. In fact, the demand for its obesity drugs was so large that Novo Nordisk had problems keeping up with production, which is why it's now expanding its production capacity. And this picture is also reflected in the company financials. Boosted by the demand for its weight loss drugs, Novo has grown strongly, especially in the last 3 years, where the average CAGR was around 26%. This made the company one of the fastest growing healthcare companies out there. However, while Novo Nordisk has enjoyed a rather untouched market position, competition has been catching up. Eli Lilly has successfully developed competing products that are now putting pricing pressure on Novo Nordisk. Investors are also worried about the high reliance on its main blockbuster products, and also some patents are running out. All of this ultimately led the stock to drop by over 60% from its all-time high. And while all of these concerns are certainly warranted, things are not all that bad. The product demand for weight loss drugs remains so strong that Novo is expanding its manufacturing lines so it can keep up. And although worries about, patient expirations and heavy dependence on Novo's main products worry investors, the company is also advancing new innovations in its pipeline. So all in all, given the mix of risks and opportunities, the recent pullback could allow for an attractive entry point. Next up, we have PDD Holdings. This is the company behind Pinduoduo in China and the fast-growing shopping app Temu, which is taking the US and Europe by storm. Pinduoduo built its success in China by offering ultra-low prices and gamifying shopping with group deals. That business is still a cash generator. But what is much more exciting is Temu, their international arm that has been expanding aggressively to capture market share overseas. And looking at the company's top line, these expansion efforts have really paid off. The company has grown impressively. It's a great combination. You have 2 drivers, a profitable cash-generative growing e-commerce giant and a high-growth global app that could become the next big disruptor in discount shopping. In the last 3 years, the company grew with an average CAGR of over 60%, while also expanding its margin. But despite this growth, investors were reluctant to invest. Just like many other Chinese companies, PDD Holdings stock was affected by high regulatory and political risk related to China. And what is more, recent tariff risks have added to this uncertainty for international retail e-commerce businesses. As a consequence, the stock is still down 28% from its all-time high, which was in 2021, despite it has its growth since then. So when weighing risk and opportunities for this one, we certainly have the regulatory risk from China and competition from Amazon, and also profitability concerns as Temu still has to break even yet. On the other hand, the company has really shown explosive growth and is a rather convenient setup with a profitable core business that enables the company to finance the aggressive market expansion until Temu will be finally profitable. What is also worth mentioning is that PTT key competitive advantages is to access the Chinese market supply chain, allowing it to source products way cheaper than its competitors, which could make it a discount leader in the global e-commerce space. Moving on to our next stock on the list, United Healthcare. United Healthcare has two main divisions. First off, the health insurance division, and second, the health services division. On the insurance side, United Healthcare offers plans for individuals, employers, and government programs like Medicare and Medicaid. On the healthcare services side, through its Optum division, it provides healthcare services, pharmacy, benefit management, and care delivery solutions. And as you can see in the financial, United Healthcare has been very stable and consistently growing its revenue for the last 10 years. There are a couple of reasons for that. First of all, it's an insurance company with highly recurring multi-year contracts. And second, the two segments, insurance and services, allow for diversification, making the revenue more stable. This makes United Healthcare one of the most reliable and consistent revenue generators in healthcare, as it has also proven over the last 10 years. However, lately the company had to deal with a lot. Rising healthcare costs, regulatory scrutiny, and ongoing political debates around healthcare reform have created uncertainty on the insurance side for the business. At the same time, labor shortages and higher operating expenses have put pressure on Optum's healthcare services segment. And this would not be enough. In December 2024, Brian Thompson, the CEO of United Healthcare, the insurance division, was tragically shot and killed in New York City. The motive being frustration with the overall US healthcare system, which really highlights the social and regulatory tension in that industry. All of these events led the stock to drop by 50% from its all-time high. So let us weigh risks and opportunities for United Healthcare. There clearly is some regulatory pressure combined with some cost inflation and operational difficulties given labor shortages and the integrated value chain. However, on the other hand, we have a stable growing business fueled by fundamental demand drivers such as an aging population, the growth of the health service segment Optum, and the unique competitive position of the business given that it's a fully integrated market leader in the industry. So this really could be another stock with a very convenient entry point just now. Next up is PayPal, one of the leading online payment platforms. Most people know it for online transactions, but PayPal also owns Venmo, a peer-to-peer payments platform that has become very popular in the US. PayPal's top line has grown steadily over the past decade, driven by increasing adoption of digital payments and e-commerce growth. Active accounts have climbed consistently with strong transaction volume growth, especially during peak online shopping periods. However, growth has recently slowed down after its expansion years. This is why after 2021, the stock has been hit hard by market rotations away from growth and tech, dropping by over 70% from its all-time high. And while the top line shows resilience, investors are punishing the stock due to slowing growth and margin pressure. Risks for this business include competition from Apple Pay, Stripe, Block, and other fintech players, as well as regulatory scrutiny around digital payments and consumer credit. On the other side, opportunities also exist. There are cross-selling opportunities with Venmo, and there is growth in digital finance services globally. If PayPal can stabilize growth and leverage its massive user base, the stock could see a meaningful recovery from current levels. Finally, the last stock on this list is General Mills. This is a very iconic consumer brand in the US. The company owns brands such as, Cheerios, Betty Crocker, or Pillsbury, and it provides packaged foods such as, cereals, snacks, baking products, and frozen foods. General Mills operates mainly US, while it also has an international presence. Its revenue is mostly generated domestically. Its products are household staples, which makes it a very recession-resilient business. General Mills had stable revenue across, the past years. However, growth has recently slowed down, and the reason for that is a very sugar-heavy product portfolio. So definitely the brand is more associated with more sugar-heavy products. And currently the consumer sentiment and the consumer preference are shifting towards more healthy products, which is a big problem for General Mills. This caused the stock to drop by more than 44% since its all-time high. So when we look at the risks and opportunities for this one, we definitely have the difficult current positioning for General Mills due to its sugar-heavy brand, where it has to reposition itself. On the other hand, management has also taken first steps. For example, it has divested the yogurt business and is now planning to shift its focus more towards, the high-margin pet food business of the company. This could change the growth and financial profile of the company in the long term, but it needs to be executed well. This concludes our list of beaten down stocks with potential for a comeback. Let me finalize this list with a word of caution. Before considering any contrarian play, I highly suggest watching the stock for some time and watching for an overall trend reversal. It may make sense to wait until the sentiment around the stock turns more positive to ensure that you are not trying to catch a falling knife. Otherwise, you will fall directly into a value trap, which is a common mistake made by investors. If you want to learn more about typical mistakes made by, beginner investors, I suggest watching my other video up here. Other than that, if you're still here and enjoy content like this, make sure to like and subscribe this video. And if you want more interesting stock ideas, subscribe to my newsletter, which is in the description below. So see you in the next video and happy investing.